going through this little loss thing that we'd had, going through the loss before. For those of you that have been with me, of course, you've already had a couple of days of that, but John Hubert put together a little special thing for like newsletter subscribers. John actually will be here at approximately 9 o'clock Central and talking for a little while, and Hubert will be here tomorrow at about 9 o'clock Central. So we'll have various discussions there over the next couple of days, okay? And let's go ahead and kick off right now. Let's start with taking this off. Now, the first things first, I always like to review the morning news to see what we might trade. That's one of the reasons, of course, we're here at 8:15 Eastern time in the morning to get any urgent news analysis out of the way in advance of news announcements. But the reality is core durable good orders are typically from day to day. Yeah, Alfie, if you can't see the charts, I'm not sure. Everybody can see the charts still, right? You can see a little calendar up on the screen here. Okay, great. I hate to ask you to go ahead and log out and log back in because I don't know if you'll be able to get back in, but you may want to log out, possibly restart your computer and log back in. Going back to what we were saying here, Jason said he had to log out and log back in to get the charts. So a few people may have to do that. So but I would urge you to do that. I don't want to see you get locked out. And that second wave of contingency, second wave comes in at 8:30 Eastern, and then the final wave comes in at 9:30 Eastern of our trader group. So make sure you're locked in by then. So the core durable goods, I'm not really expecting, just like any other time, I never really expect core durable goods, certainly over the last year or two, to go ahead and be a big barn burner. If the market moves off that news, it's likely just an excuse that the market's moving because of all the other things that are pending right now. Okay, so I'm not expecting a big trading opportunity off at 8:30. Now, jobless numbers, unemployment numbers, and stuff. So Thursdays and Fridays, that's a little bit different story. So we'll be singing a little different tune tomorrow morning for the Thursday numbers. Okay, so we'll flip over that for a moment. So unemployment numbers, those will be some things we're going to keep an eye on. But what I've found the last few months, as you know, for everybody that's been here, and for those of you that haven't been here, here's just something for your benefit, that really the Trichet speeches have been the most effective. In fact, there was like an open house back in, I believe, the end of June where Trichet was speaking. That was the day where you guys watched me make like 72 ticks in like 10 seconds or something. That was where the markets went ahead and spiked up. And I said, look, that could be a fake out there. Trichet's starting to speak, be careful. Then they immediately dropped down about 90 ticks or so. I went long as it fell back into the support, and then it jumped right back up. So, yeah, you remember that, Jay? So that's where I've really been finding the real bang for the buck recently, gang, is on the Trichet speeches, okay? So just to give you a little heads up, the 8:30 news announcements have been kind of duds, and then the 8:35ish, that's when the heat would pick up when Trichet's speaking. When there's a bank rate statement and then he's coming up speaking, just so you understand. All right, so armed with that, let's go back here, move that aside. The other thing to keep in mind for those of you that haven't heard. Basically, what we're doing is we're kind of on government watch here. Yesterday, we went ahead and had here the significant announcements. In fact, if you watch like MSNBC yesterday, you'll notice that this whole section was about the president and the government in general, Bonner and so on and so forth. And so this was all, they had their dueling pictures and big statements. So that's kind of where, we're at with that. I mean, that's mainstream, okay? And then, of course, on top of that, we went ahead and had, in the regular news, we're seeing quite a bit of things relating to this event as well. Let me just move my pen color over to a different color and get that up here for a moment. All right. So you're seeing comments here. You're seeing comments here. You're seeing comments here. Yesterday there was even more, of course, that were up there. Today we're being overshadowed a little bit about the Google's going to 1,500. Comment here. But yesterday, of course, even up in here, it was all about debt. So effectively, you gotta get a little nervous when it starts saying Google's going to 1,500. You hate to see stuff like that because the last time gold and silver were and remember crude oil back a couple of years ago when that was forecasted to go to $200 at the time. That was kind of a kiss of death. So you always got to be careful when you see that. But that's a story for a different day. For today, though, understanding that it's still very much in the financial news and the public news. A very tepid situation. Now, just so everybody understands, for those of you that are just guests from Johnny Hubert's newsletters, one thing that I focused on as an example, we had a really healthy discussion on that yesterday. This is the Japanese yen. Does everybody see what happened there the other evening with the Japanese yen, where we spiked down from approximately the $1.2840 area down to $1.27 in a couple of seconds? Did everybody remember that from the other day? And the reason why this is so important, this was just when the president, this was the other evening when the president came out with his announcement, the deal hadn't been reached, and kind of, people actually do watch MSNBC. We'll watch, we're going to be careful, Greg, no political statements, today, but yes, CNN, all Fox News, the MSNBC, all those get watched, and they're considered mainstream media. And so when we're seeing so much talk about the debt in the public eye, what we have to be careful of, that's usually where you get your biggest moves. Back in the day with the FOMC, when we used to go ahead and actually people cared, was like, hey, is Greenspan going to raise rates? Are they going to raise rates? What's going to happen? Back in the day, what was happening was you actually had big, reactions to the news. Okay, back in the day. Well, then now, if you think about it, since December of last year, who really cared, right? I mean, honestly, who really cared about the FOMC statements? Everybody expected they were going to leave rates unchanged, and nothing was going to happen. And what was the ultimate result of that? The ultimate result was that you barely even would recognize there was a move or that there was an FOMC statement, right? And now, since they went to the split FOMC statement, it makes it even that much tougher as the news is kind of part and parceled out. So, we have the kinder, gentler Fed that is, trying to model the old Greenspan model of being very transparent and such. So, getting back to this though, right now we don't know what's going to happen exactly with the debt situation, and just the talk of the debt is going ahead and causing 140 tick swings in the Japanese yen. Okay, so this is the kind of thing that I want to go and make people aware of. Now, this happened very quickly the other evening. I'll just go ahead and pull this out. There it is. This is a 5-minute bar. This happened very quickly. Now imagine, even if you had a stop in up here, because of how this came down so sharp and fast, your stop, because of fast market conditions and overnight trade there, could have easily been filled down here below. Okay, as always, there's no guarantee if you put a stop in up here that you're going to get filled right there. Especially in fast market conditions and overnight trade, nobody's going to listen to your concern. So the reality is there's a lot of risk right there, and that's just another fine example of it. So being in what we found was like last Friday, John was trading and having a devil of a time of it. Monday came in very choppy as well. Yesterday, we were getting ready for today's event. We actually ended a little bit early. We were going through a little over 30 different bullet points for all sorts of new changes. We're not going to discuss those changes to the room, but to make a really good room even better, we went ahead and put together all of your feedback and ideas and comments. And so we have about, I believe it's about 29 things that we're going to go ahead and is what it ultimately ended up being. That we're going to go ahead and discuss. So that'll be tomorrow morning, though. The different changes, the 29 different things that we're going to be doing a little bit differently and stuff. So stay tuned for that. So let's see, Rob. Hey, good morning, Joseph. Does the fast market condition basically lead to slippage? Yes. Putting it another way, Rob, it basically leads to a license to steal. If you put it in those terms, it kind of gives you perhaps a little better visual. What it means is that, let's just pull this back out. Okay. What it means here in very simple terms is, let's say you went ahead and had a stop here 5 ticks down below the 20-period moving average, okay, because you're doing a trend trade, looking for a pullback. It doesn't bounce at that key support. The TC20 trade fails, and there's a stop here. Your stop may get triggered, but it may get filled anywhere along this pipeline, okay, when things are moving fast. There's no guarantee. You may have your stop here, but there's absolutely no guarantee that it's going to go ahead and get there and get filled there. Okay. And now the question, if you remember from the discussions the other day with Jefferson, the comment was, well, can the slippage possibly help you? Actually, in a positive way? Could you get positive slippage, like your profit target goes ahead and actually gets extended? So let's say you were short and you put your profit target here, could you actually get it filled down here? My personal experience has been, that that's not the way it typically works. Okay, and so basically that's kind of my experience. It's far more likely if the slippage will not work in your favor than work with your favor. That's been my personal experience. So don't count on the news release going ahead and being a savior. Yes, they can also go ahead and leapfrog over your stop if there's a gap. So in other words, and that's what happened to people that were trading silver. For those of you that don't remember, I think I was with Tom Sosnoff at a 4-day event in Chicago back in May, I think it was. He came and spoke, for our company, and he talked about how I think this woman lost about $3 million, I believe it was, on the silver, where it went ahead and gapped down. From Friday night going into Sunday, you had the big gap. So you don't get filled, if the market closed here, your stop was here, you don't get your stop up there when it gaps down below. You understand what I'm saying? Does that make sense? So people do need to understand that about stops. And of course, we're going to be talking more than ever about stops as we go into next week. Monday starts a lot of those different changes. And for those of you that don't know, I went ahead and had physical stops, and I used to use physical stops until the flash crash last year. But then I got myself into a series of trades where it just took me out too quickly with a profit, and I got frustrated trying to move the stops and beat the stop, the profit target there, and extend them out. And so I actually stopped using physical stops and just went to mental stops at that time. So we're going to be talking a lot more about those as we go forward there. You're really perhaps a hedge. The question is, how do you prevent the gap down stop out, leapfrog? You'd have to really consider a hedge. So in other words, if you're going ahead and shorty, this is just an idea, to consider, not advice to you specifically, but people might want to consider options. Perhaps if you're like some of the institutionals, maybe if you're long silver, you're short, gold, something along those lines. Maybe consider different types of hedges. But you can't, if you're going to trade into Friday night, you really can't. There's no guarantee that your stop, which is here, if it gaps down to here, you're not going to be able to get the fill there. So you basically have to look to hedge it. Okay. Yeah, no, I had both. Great question on physical stops. That was both profit target stops and stop out stops. Kavork. Yeah. So that may have been for your time there. And so Ryan, I'll be doing that when I get to it today. Yep. So you just have to sit and relax. And I realize, gang, there's some people here that their sole purpose in life is because they like train wrecks and car wrecks and so on and so forth. And their sole purpose in life is just to go ahead and get the goods on the loss. I'll be talking about that shortly, I assure you. And then for everybody else, I'll be talking about, like I said, like the positive changes for the room and stuff like that. And Johnny Hubert will be talking about different things, but that'll be when we get to it here in a little bit. First, I'm going to do analysis because it's still the live market trading. Okay, so so going back to this for a moment with the risk analysis there, that we go ahead and basically had this situation where 140 tick gap down, and that's when the president was just talking about the debt. No deal was reached. Anything was decided upon. There's no indication that, okay, they were going to actually default. Can you imagine if we get into that state where next week, here we are, Sunday night, Monday morning, there's no debt deal reached, the kind of implications that could have for the market. Or as we're talking, for those of you that are trying to protect yourself this weekend with stops, one thing I would consider you to think about is if we go into Friday close without a deal, if it were me, if I were in the government, I think a lot of things would probably be different. But if I were in the government, I would actually announce it like Friday night after the close, giving the market the whole weekend to absorb the data, okay, and think about it, cool off, maybe temper the reaction. Because pick your poison, whether you're Democrat or Republican, the last thing you want to do is come up with a debt deal and then have the market tank a couple thousand points and get blamed for the deal, right? So that would be the way I'd play it. But nonetheless, the hardcore reality is at any moment, any time, that's funny, Tom. So the real deal is that at any moment, any of this stuff could go ahead and present itself. This announcement. But for those of you that have short-term swing trades, perhaps don't have maybe a lot of profit in a trade. Okay, you go ahead and have a short-term swing trade, maybe a highly leveraged position, something like that. You really are going to want to think about whether it makes sense for you to go ahead and actually, hold that position, because that position could close here on Monday night, Friday night, excuse me, and then Sunday night open significantly lower or theoretically significantly higher. Well, so if you short going into the weekend, betting on the big downfall, that could, be painful on the way up if it gaps up, and vice versa. You're going long, betting the deal is going to be reached, and they don't like the results, it can push down. The bottom line is the risk versus the reward of holding over the weekend, pretty ugly. Okay, that's my opinion. I certainly won't be holding any leveraged or unleveraged swing trades over the weekend. Okay, so all I have is some long-term investments that are in fields that would weather that kind of storm. So that's my thought. Okay, and so for stops, just close on that theme, that what people have to be prepared for is gaps over the weekend, and or in any time as we go forward the next couple of days, like John found on Friday, I found Monday, that basically 140 ticks like that, okay, which on a one contract trade, putting that in perspective, one contract there, that's a significant move. Do the math, $12.50 times 140 ticks there. So keep that in mind, and when it moves that fast, you can have a significant amount of slippage. All right. So with that being said, I just want to make sure everybody's aware of that risk. Okay. Now, as we go to look to the 7:30 news announcement that came out here just a little bit ago, you see very uneventful. That part's not a real surprise. Let's see. Okay, Ava, thanks. So let's flip over to the Russell for a moment. Now, I don't trade the Russell in pre-hours typically, but here's what we're looking at with the Russell. So we'll be talking about the Russell actually as we go into the regular session a little bit more. Does everybody understand? Does anybody have any idea, maybe for those of you that are newer, why I typically don't trade the Russell in pre-hours? That's right. The volume, exactly. So basically, that's right. You got it. Volume, liquidity, etc. That's right. Look at that. So here we are. Just a little bit ago, 100 to 300 contracts. As most of you are aware, I could very easily, become a market maker and own this market there. Okay. So, yep. Paul, you're probably going to get some of that. That's what we're kind of doing. We're going through, starting with we're going to go through the different instruments. I just wanted to share one of those things that, to your question there is basically just that. We're going ahead and looking at why I'm not trading, for instance, the Russell right now. Wouldn't do that till closer to the U.S. Open. Okay, and so little tips and tricks for you to think about and learn from there, Paul. So let's go ahead now, get back over to the euro. We got past the news. We talked about that risk factor, and we talked about why it's so risky. And does everybody understand that? Does everybody understand that impending risk and why it's there, what that risk is, what that risk can look like, what it did on the charts, like just the other evening when the president was just even speaking about the debt deal, and how that moved like the yen 140 ticks, and that could be you on the wrong side of the trade. So, oh yeah, go ahead and, well, Patrick, I'm not going to be able to really repeat it right now. Because we got to move on, but suffice it to say, it's very, very risky right now. Even when they're just speaking about the debt deal, we're going ahead, and this is the Cliff Notes version. Sorry, you weren't able to get in, but right here, just look at the Japanese yen from the other evening, how in a matter of seconds it spiked down 140 ticks. Okay. Yep, there are charts up, William B. You may have to log out and log back in. Hopefully you'll be able to get back in there. Okay. All right. So let's go ahead and go back to the euro here. And sorry, gang, of course, as always, we have a large group, and so there's different people coming at different times and asking different questions and such. So trying to be as accommodating as possible. And no, not really, Lee. To have known it was going to go ahead and push down 140 ticks. The interesting part about that, Lee, is I'm actually watching for the Japanese yen to push down sharply, but not because of the discussion about the debt issue. Does anybody have any idea why I'm interested in the Japanese yen and have been watching it pretty closely the last couple evenings? And Paul says, thanks for doing these 2 days. By the way, Trade the Markets is great for clients. Yeah, well, thanks, Paul. We're trying to go ahead and help. We try to turn good experiences and tough experiences into great learning opportunities, no doubt about it. And keep that going. That's right, Bank of Japan intervention. You got it, Julius. Nice job. And yes, exactly. All of you that answered there, Bank of Japan, you are absolutely right. So let's just go ahead and flip to that, since we were on Bank of Japan, or we were on Japanese anyways. What everybody should understand is that as we go ahead and look at the Japanese yen, first of all, the Japanese yen in general, for me, Rob Hoffman, tends to go ahead and be traded most during extreme events, news releases. Okay. Now, as we go back in here, the Japanese government had announced that they were going to go ahead and try to devalue their currency. They were not happy with the price of their currency. Does everybody remember that back in August timeframe last year? And then what happened was they actually came out and did it, in overnight trade. Okay. And I believe they did it again on this day as well. It seemed like I got two trades out of that. Well, it was more than two trades. I got multiple trades, but it was like two different evenings that it happened. This one and this one, as I recall. So basically, they kind of pre-announced that they were looking to devalue back here because they didn't like this price area. Then they went ahead and actually made good on that threat on this evening, and I believe it was this evening. So had some really good trading in those evenings. Just in general, the Japanese yen, most of the trading I do on that is event driven. You'll recall I had earned approximately $21,000 back earlier this year during the tsunami. The week of the tsunami. Most of those trades, with the exception of one or two, were very small contract trades. But the market was so volatile, it was given 20 tick, 30 tick, 40 tick. There was even one trade where I did the two contracts for 100 ticks apiece, in one overnight trade on the yen. So the point is, lots of great activity that week. It was a tragedy, and we felt bad about it, which is why we did the free charity event to try to raise money for them, for all of you that will recall. So, but the point being is that with the Japanese yen, we're really going ahead and focused on the event-driven type trades. So, right, currency devaluation definitely fall into that category. And then, of course, as we flash forward here, we went ahead then with the tsunami crisis, the earthquake and tsunami, that whole situation that led to some great trading opportunities. Terrible tragedy, but great trading opportunities. Okay, and here's that night where it gapped up, pushed up, and then came right back off with the currency stuff. And then of course they did a coordinated effort with the other central banks. Does everybody remember that? Back here in March, they had the spike up, and they did a coordinated intervention with the other central banks. Okay, now this is real important, so I want to make sure everybody understands that. That's what happened here. Okay, now, okay, good. I'm glad you guys remember that. So now, then as we go forward, the reason why this is so important now is because guess where we're at? We're right back up there in that range where they've proven, first of all, they didn't like their currency back down when it was $1.20, $1.21, right? Well, if they didn't like it at $1.20, $1.21, they're sure not going to like it as it's up here at $1.2850, right? Okay, so the last time we got up to these nosebleed levels, they went ahead and had the intervention. So what I've been doing is watching the Japanese yen for a big devaluation in overnight trade again, because the conditions are highly probable and ripe for another devaluation based on the Japanese government's desire to keep the valuations lower. Okay, and they've proven it. They're not just jawboning, as it's referred to. They're actually doing it. Okay, they've proven it back here, as I was showing you before. Okay. So yeah, basically, from my perspective, so with the rising trend underneath, the way I've played that each time back there late last year, I would look for the sharp drawdowns and buy the rising support. Okay, that's what I look for, buy in the rising support after the knee-jerk reaction down. If you can't see the screen, Mark, you may have to go ahead and possibly log out, shut down, restart your computer, and log back in. Okay, so might be a little technical glitch for you. All right. So I just want to kind of point that out about the Japanese yen. That is what we're looking for. Not going ahead. So getting back to the original question, was I really looking for the Japanese yen to be a big mover that evening when President Obama was speaking? The short answer is no. I've been watching the yen because of a devaluation situation. Okay. That'll be real tough because that move will likely happen in a matter of seconds there. Okay. No, you can't, Carl. So the as we go into the as we go into the euro, then let's go ahead and do the analysis on that. Now, what I like to do with this is, let me just watch the time because I want to make sure I have enough time before John comes in where we can talk about my previous loss. I want everybody to be able to learn from that. So the let me just kind of run through my analysis on these trades. What I'm looking for with the euro. First of all, we know the euro dollar is very sensitive, obviously, to the upcoming debt announcement. Sometimes when it gets sloppy, when we have some intraday downward movement, we have to reflect back on the daily chart, and the daily is actually still rising from a speed line perspective. We're going to talk a lot more about those next week. But net, from a trending perspective, the way we conventionally analyze a trend is from left to right, where the 20-period moving average starts on the left side of the screen, draw it over to the right, and that's basically flat. So in other words, it's just as easy for the euro to come down as it is to go up. Also note, with the team that I have here yesterday, I've got 6 of our student family here in the back cave with me today. We were looking at doing trades yesterday afternoon in the euro, and we saw that the $1.45 level was this hardcore resistance. If you notice, as we go back in time, $1.45 is a very important resistance level going all the way back to April of last year. Notice, for those of you that don't know how I draw my support resistance levels, basically you have here the high, the high, the high, the close, the low and open, okay, near the low, lots of touches. Everybody see that? Lots of activity at this level. So that's a pretty important level. So we knew that historically going into this area. Okay, so I'd already had, of course, that level pre-drawn. We've talked about it in the live trading room here, each day there. Well, so we got up there, so there was no room to grow. So we backed off, made long side trading there, and now this morning we're pulling back from it. So all we are is caught between a rock and a hard place here, between the support levels right here, this key support at $1.44. Those of you that have been with, you know what that's been like the last several days. And so we're kind of caught between a rock and a hard place right this moment on those. So we'll try to see if we can get a better picture from the dollar, the inverse then of the euro. And what we see in here is the dollar is in kind of hurry up and wait mode now. We've done a good job of getting down below this key band. For those of you that aren't aware, this 75 to 76 is a very important band to me. And let me just show you historically why. So you'll notice here, going back into 2007, we went ahead and bounced off that band, traded down below it. When we got down below it, we actually stayed there for more than half a year. Got back above it with a big wide range bar, pulled back to it, and then that led to a huge rally in the dollar. Then and that was in 2008, all through 2008, that was very significant. So basically the whole year was about the dollar there. Then it went ahead, and in 2009, came all the way down to, guess where, and held there for a few months, bounced off. Then in 2010, we fell to, guess where, right there. And then we went ahead and held the support. Now here we are again at that all-important level. So does everybody understand why this area is so important? If we go ahead and break down from here, from a swing trading perspective, from an intraday trading perspective, it's all very important. If we go ahead and we push down from here, we could start watching. I jokingly said we could watch the dollar become a peso. Okay, you have a significant move down after the consolidation. If we can bounce from here, history has shown you can get some very nice rallies, aka shorts in the euro. So watching this level quite intensively. Okay, everybody understand that? Does that make sense? It's a multi-year event at this area. Okay, so let's go ahead and move on here. So getting back to the, yeah, you're welcome. Good. All right, so basically, let me pull the daily back into this. So I'm basically in a hurry up and wait mode on the euro at this moment. I've got intraday some short-term signs of weakness, and yet all we've done is fallen into rising short-term support. So I got short-term weakness on the intraday, short-term strength on the end of day. Okay, so I do not have a confluence there. I do not have a high probability trade there. Okay. Nate here, that's a great question. Nate says, hey, hasn't the dollar really kind of broken down? Here's what you got to keep in mind, Nate. This whole thing, this landscape could change momentarily. Right now, the market doesn't like uncertainty, and the whole discussion about defaults, okay, and all this news out there. All right, U.S. may have to cover bills after debt deadline. Okay, this kind of thing right there, not very exciting for the U.S. dollar, is it? Right. So right now, the market's in the worry stage, Nate. But as soon as we go ahead and get the announcement, there could be a relief rally off of this, kind of the sell the rumor, buy the fact kind of thing. You understand what I'm saying? If we were not waiting on impending news, Nate, I'd be singing a different tune there. In other words, if this just naturally, technically went ahead and had a move, so yeah, in this case, that's right. Because of this type of very specific, internationally watched news event, to the point where every day it's front page, top headline news in the public mainstream media. That's why. Normally, I don't. For all of you that know me and know my work, I don't pay that much attention to news. At 8:30 in the morning, 10 o'clock Eastern, a news announcement comes out. I'll spend 5 minutes waiting for the news to come out, trade a news announcement accordingly, and then walk away and not discuss it anymore. This one's a lot more different, Nate. Yeah. So basically, in this case, all bets are off. Technicals can go ahead and be short-term superseded by fundamental news. Okay, I've seen trades like around the Japanese yen time frame where they had a beautiful uptrend on an intraday chart. The Japanese yen news came out about the tsunami, and the thing, and some of the markets just tanked. Right. I saw some really good trades like in crude oil earlier this year that were good shorting opportunities. And then the Suez Canal news came out, Egyptian crisis, and the market spiked up hard. You get my point there, Nate. That yeah, in the short-term basis, short-term fundamental news can go ahead and ultimately defy some of those technicals, especially when it's a traumatic news release event. Then the market can settle back into its intended direction, but in the very short term, it can supersede it. Does that make sense? And does that make sense to everybody? Okay, makes sense to my group in here. Great. And good. Okay, excellent. All right, so basically let's see here. When I see headlines like that, look for the reversal. Yeah, one thing I look for, Steve, like here, this kind of thing, Google going to 1500. Yeah, I get nervous on headlines like that. Okay. Yes, I do. What I do, Gary, is let me be clear. Gary says, if we join your room, will you call out plays, stops, etc.? I'll definitely be showing you what I'm doing, where I'm entering, why I'm entering. In fact, like I said, as of Monday, I've got like 29 new improvements, even tweak the room even better, Gary. But just to be clear, this is not some sort of like trade alert service type thing. I'm working really hard to educate you and have you watch my very real trades right there live on the screen in front of you. So I just want to make sure it's clear. That discussion came up the other day. I'm not just some rinky-dink, what do you call it, channel call operator guy or whatever. I don't know what you call it. I'm not there for entertainment value. I'm really there to educate the heck out of you, have you watch my very real, big trades. Okay, so they're not all big. Some are small, some are big. Big wins, big losses. I'm actually going to talk about a loss today. So that may not be as exciting to you, or you may learn a lot from it. But just go ahead and make sure you understand. It's not just meant to be, some sort of, alert service type thing. There's a lot more to it. Try to work real hard with you guys to teach you something. Great question. Yeah, well, actually, you know what, Jason? The reason why I dedicate so much space is like for instance, down here, these tools are important to me. Volume is important to me. My trend analysis tools are important to me. The RSI I use for pattern analysis. I have a couple tools called like fish hooks and crooked fingers, for instance. So those things are important to me there. I don't need a lot of real estate. I know a lot of people go ahead and they have like 4 monitors, 6 monitors, 8 monitors, and more. We were kind of joking about that in the room here yesterday. People were whipping out pictures. I was that guy back in the 90s, just so you know. I had a bank of computers. It looked like when we were running into the NASA space shuttle. I had 2 laptops on the sides and a whole bunch of 15-inch monitors back then. It looked like the Matrix. It really did. It really looked like the Matrix, or a space shuttle when you walked in there at night. The bottom line is, for me personally, Rob Hoffman has learned that less is more. So over the years, I've kind of learned and adapt to that. And so I kind of have, and I do multi-time frame analysis, so I kind of have everything on the screen right here in front of me. Okay. So hopefully that helps with that. And yes, this is e-signal charting is what this is right here. These are e-signal charts. Okay. All right. And that's funny, Jason. Thanks. So, all right, let's go ahead and kind of let's see if I missed any questions there. Yeah, no, David K. That's right. I'm not the alert lunch. Hey, Aronson, I can see your message there. So your test was successful. All right. So, well, sometimes you'll put test messages in to, see. All right. Thanks, Ava. Let's go ahead and just quickly move on to a couple more of these charts. Then I want to go ahead and get into a great learning opportunity. The gold, I've been very bullish on gold for the last several days. That continues to go ahead and be the case for those of you that are swing traders from a technical perspective. Now, from a fundamental perspective, no, Enid, it's not just audio. If you're having a problem with the chart, you may need to go ahead and shut down, restart the webinar and your computer. Okay. So you really might want to go ahead and do that. Okay. Let's see. What are those yellow blocks between your charts? Oh, sorry. You know what? That was just the marker. I'm using a marker here, a yellow marker, and it kind of traps the colors. See, like that right there? It's just trapping the color. No worries. There, I'll just take that off. Okay. Yeah, those are the secret buy signals, Rob. I'm kidding. It's a joke. Everybody's laughing behind me. Yeah. Rob says, I knew it. That's right. Darn it. They discovered me. I thought I turned that off in time. Just kidding, guys. So the bottom line is, the thing is, now kind of going back to the conversation I had with Nate, I've been very bullish on the gold. Okay. Technically speaking, I have what's called a senior uptrend. Perhaps tomorrow we'll have more time to talk about that. I want to make sure I have time to dedicate, to a great learning opportunity from a previous loss I had. But we have a senior uptrend on the daily charts. I've been very bullish on that. And then as far as, but the problem is, going back to what I was saying with Nate, from a fundamental perspective, is there any reason why the gold could be perhaps in jeopardy at these levels? The safe haven threat. That's right. Basically, right now, people are flying into gold. It certainly, yes, it's been in this really, a nice uptrend here. The market's been climbing a wall of worry. Gold is a flight to safety right now when the U.S. dollar is in jeopardy, right? Exactly. But if we come out with a debt deal, all is right with the world. Yeah, Steve. Well, exactly. A favorable debt result definitely could put it in jeopardy, or actually just even any debt result, right? If we, when these kind of headlines on the front page news, U.S. may have to, may have a way to cover bills after deadline. After these kind of headlines about debt, deadlines, and Social Security payments, and all that kind of stuff, after that goes ahead and comes out, then it can be the whole buy the rumor, sell the fact time thing, where, okay, gold was a great little safe haven, but now the government's getting their act together, and then we could have a huge spike down. Okay. So that's why gold, from a swing trade perspective, like for instance, if I were swing trading gold right now, I personally would not. My opinion is I would not be interested in holding this right now, because at any moment, we know that they're ratcheting up the rhetoric, trying to go ahead and get a deal done. Any moment they could announce the deal, and that could send gold potentially into a spiral down. Does that make sense? So the safe haven suddenly isn't such a safe haven. Okay. I have to agree with you, Steve. Steve says gold is all over the newspapers for Joe Public and Jane Public to buy. That if you recall, that was actually the same case back several months ago, Steve, in silver. Same thing, different situation, and and we talked about that here. Steve, you obviously weren't here during that, but we talked about that. And what I did was I was pointing out how silver and gold were like in 5 or 6 different spots. I kind of use the marketwatch.com as one of my barometers. When I start seeing comments there all over the place, I'm getting pretty nervous. Okay. All right. Yes, it's the same thing for multiple investment. Whether it's equities, you start seeing too much of a good thing, and the Main Street public. I mean, it's the old thing, when my barber starts asking me, or my mom starts asking me, hey Bob, do you think I should go ahead and be looking to buy this or sell this? I start getting nervous. Okay. Let me see if I can just spin through a couple other things here real quick. The crude oil, the daily chart, I'm not a big fan of this on an intraday basis. The only thing that the only opportunity would be short-term shorts against this falling, intraday resistance. But I don't like the fact that we're above the 20-period moving average and other key support areas on the crude oil. Crude oil, of course, will be has been and will be very volatile. It has been for the last few weeks. Crude oil, in my opinion, as I always say, I don't think that's a great instrument for novices to go ahead and trade. New wealth building traders, new small lot traders. That's a pretty that market can move 30, 40, 50, 100 plus ticks very fast. It's had multiple 400 tick, 200 tick, 300 tick, and 400 tick bars in the last few months in an hour. In an hour, that's like up to $4,000 per contract in an hour. So keep that in mind. So right now, I'm kind of holding pat on crude oil in particular. Talk about stops that can get blown. For me personally, I'm avoiding that one right now. And certainly at a minimum until after we get this announcement out of the way, then I'll revisit it a little bit more seriously. So let me go ahead and let's look at the Russell, and then I think what we'll do, was there any other instrument, real quickly, what do I got here before John comes on? Any other instrument that I can look at, maybe the S&P or I'll look at the Russell here real quick. The Russell, we were looking at doing some short side trading yesterday afternoon, but we went ahead and saw we had this key support level in here. This area has proven to be pretty formidable, this 820 area. So we backed off from that. And what I was looking for yesterday afternoon, for those of you that don't know, I do trade the afternoon sessions. I just usually do it privately when I do it. I don't trade every afternoon, but I do it privately. But that's going to be one of the improvements, which we'll talk about tomorrow, one of the 29 improvements. So stay tuned for that tomorrow morning. So the bottom line is we did not go ahead and take the short yesterday afternoon because there was an area of support that was forming up there. Now, on an intraday basis here, I'd like to go ahead and be looking for short side trades here against the falling resistance. Everything's saying sell on an intraday basis, but the dailies are right at this key support area. So I'm going to go ahead and we're 20 minutes before the U.S. Open at this point. So we'll wait. We'll see what happens with the U.S. Open, but I'm going to be kind of focusing during that time at this presentation. So with that said, let's see, British pound, sure. I'll take a look at the British pound for you real quick. All right, so the British pound, you can see there, Jay. First, I'm sure it's a favorite of yours, being in the UK. The 5-minute slightly down, 15-minute down, 30-minute slightly down, hourly slightly up. When somebody's looking at that, for those of you that don't know my work, I'm going kind of fast because I'm just trying to wrap this up. So I'm just doing this for an existing student. Looking from the left side where the 20 period starts on my chart to the right side gives me a feel, because when I see it slightly up like this and the market's been going down, I worry about a snapback rally in RTM, reversion to the mean, back up. Okay, so, and also we have rising support right there as well. So I'd really like to see us get above the $1.64 level, Jay, and then we can go ahead and we can talk turkey on that, probably a little bit more tomorrow and as we go forward. Okay, you betcha. All right, let's go ahead and do this. A couple people going ahead and asking for different instruments, but then I'm not going to get into losing trade stuff. So I'd like to go ahead and talk about that a little bit. So let me go ahead and push back some charts. Just take me a moment to do. And if there's any other questions you guys have, you're welcome to go ahead and post them real quick. I'll see what I can maybe answer while I'm kind of reconfiguring the charts here. And it didn't lose sound. I'm just going ahead and kind of queuing up the charts here. Almost done, gang. Yeah, no, I did not. I did not put up the S&Ps there, Greg. I can go back and look at those. Yeah, toss can be. I just won't be able to do it now. Let's get through this, Gary, and then maybe we can look at it, and or John and I can look at it when he comes on. Okay. All right. I think we're in pretty good shape there. That looks about right. Okay. The yeah. So getting back, yes, toss charts. Toss charts can effectively be set up like mine, with the exception that the pivot points don't quite line up. The pivot points don't quite line up there. The U.S. dollar future symbol there, Mark, is the DX. Okay, right here that's for the E signal. That's for E signal. DX space F. Okay. Hey, by the way, yeah, Gabe, if you need a clarification on that, by all means. We got kind of a little bit, if I'm being told for TradeStation, it's $DXY. Okay. And for toss, it's /DX. Thanks, gang, for helping, student colleague there. So okay, I think we got yes, Rob. Yeah. And Gabe, so if you need any clarifications there, by all means, yeah, because I'm bouncing around between, we have so many of our existing student family, and then we have guests today, which I believe you are one of them. So if I just skipped over something or whatever, I went too fast, I'll be happy to try to help. Okay. All right. So let's go ahead and pop up a presentation here. And John and Hubert will be here as well. So let's pop that up. So it's Ron titling Getting Back on Track After a Loss. John will be here in approximately about 45 minutes. And Hubert will be here tomorrow at about 9 o'clock Central. So the format, what I'm doing here at this point is I want to kind of go through some really important opportunities there for people to learn from a mistake that I recently made. And I'm not imperfect by any means. I'm sorry, I'm not perfect by any means. Let's try. You know what I meant. I am imperfect. I am not perfect by any means. So hopefully you went ahead. Let's see. You sound like you are beating yourself up on a loss, dude. You are the master. Don't feel bad at all. Yeah, no. Listen, it's just that. I mean, it's a great learning opportunity. It was a bigger loss than I'm accustomed to. My last loss in the live trading room was January 10th of last year, and that was a fraction of my biggest winner of the year last year. This time, I totally inverted it and I screwed it up. And I think there's a way for people to go ahead and learn from that. Because I beat myself up, if you will, if you want to use that that terminology. I always try to make things better. And in fact, like I said, out of that, we actually got 29 new improvements, which I'm going to go through tomorrow to the room. So that's pretty exciting. Okay. And so let's go ahead and go through this. So the format for today, I want to kind of spend a little bit of time on this loss. Then John's going to come in and he wants to talk about I believe it's like stops and profit targets is something to that effect for small traders and such. So the point is that this is going to be some good stuff from John, and then Hubert is also going to talk about psychology, getting on back on track and that tomorrow too. So, and then I'm going to show you some of the other neat stuff. So let's go ahead and get right into this and push right through here. Okay. So this is a formal presentation that's being made by us, and so we're reserving the rights on that. I don't want to have to read all this. I'd encourage you to take a screenshot on it, read it later. I don't want to have to read all this legalese. I don't like it, but it's necessary. So enjoy the information here while you're here with us today. Okay. Then as far as this one is important. Because we say it all the time. We talk about risk. Hey, I just had a loss myself here recently. Okay, losing is part of the game. I took a bigger loss than normal, obviously, on this other trade. So a lot of these $10,000, $20,000, $30,000 gains and stuff like that. all the different stuff that I've been kind of working on here recently. Um, I end up giving a lot of that back. So, I think it's important for people to understand that, this is for educational purposes. I'm not a registered financial representative. John and Hubert are, but I'm not. I don't hold myself out to be one. And there's lots of risk. There's reward too. Everybody always focuses on the reward, but there's risk, and you have to be willing to accept those. Don't trade with money you can't afford to lose. Okay, that's why people are like, gosh, you took a hit on that, and yet you're not like freaked out. Well, because I'm trading with money that I can lose and still go on with life. And that's important, for people to understand. And of course, for those of you that have been with me over the years, that's also really important to understand. Whenever I make money, you're not seeing me bouncing off the walls saying woohoo, and you're not going ahead and seeing me go ahead and get super upset. I always try to focus, especially particularly on the losses. I try to focus on the losses because they're such great learning opportunities, in my opinion. And like I said, that's the last big real evolution to the live trading room was back after January of last year. Even though that was a much smaller loss than my biggest win of the year, so everything was more in alignment. It was still a great learning opportunity. So, and some changes came out of that. Now we got the 29 additional things coming out. So I try to use these for the betterment of all. Past performances, of course, no indicative of future results. Consult financial representative. Okay? So, take a screenshot of that. Go ahead and read it. All right. And so the so how I typically avoid the trouble in the live trading room for myself, and where and why I failed to continue my most recent run. Unfortunately, what happened the last month or so of the live trading room before my loss, if a lot of you noticed, I went ahead and I spent a lot of time going ahead and here that was last year, Jack J. So that's what I was referring to for that year. Okay. And so basically, to make a long story short, the last month of the room, what I found myself doing a lot, it seemed like more people were like, hey, you're almost to 18 months, et cetera, since the last loss in the room, and so on and so forth. And last losing position in the room. And I'm like, look, gang, you guys are putting more emphasis on this than me. I would not be concerned about that. And I really tried to say that several times. And yeah, sure enough, maybe I talked myself into the loss. Who knows? But the bottom line is that I found myself that last month in particular really downplaying. In fact, I was at the Dallas Traders Expo. For those of you that don't know, I'd won the Dallas Traders Expo competition, and then there was a presentation I did that night. It was a full room, a full house, and basically yes, traders did make money on it as well. Some traders lost, some traders made money, and we'll talk about how they did that as well. Yes, but I'm trying to focus more on the losing side of it. Not that it's a negative message; it's meant to be a positive message. But I don't want. I can talk about what they did right in my trade because I'm familiar with it. But that's I'm trying to focus on the loss side right now. Okay. So when I was in Dallas at the Traders Expo there, I'd done this presentation. I never mentioned, how I'd been doing in the live trading room there. It was actually one of my students who was in there who went ahead and actually mentioned it. And that was at the end of the presentation. I'd gone through the entire presentation and was just doing Q&A, and I never mentioned it. Everybody else was making a bigger deal of it than me. So I got to be honest, it really kind of created its own pressure. You know what I'm saying? So we'll talk more about that tomorrow. But but typically the way I tried to go ahead and avoid the failures is I would usually have the patience not to gamble. Use a kind of a methodology I call my way or the highway. And so basically what was happening was, I would try to stay on my path, stay on my plan, and if a trade didn't meet my plan, I went ahead and would avoid the trade. Okay, so that's what the my way or the highway is meant to be. Okay, so staying on my plan, not deviating off, because when you deviate off, bad things can go ahead. Bad things can go ahead and happen real fast. I also like to have backup to my backup and then backup to that backup. All right, so that's part of my decision tree. All right, as I look at the decision tree here, sorry, there's a little bit crunchy here. Let's see if we can make that a little bit better. Doesn't look like it's doing it. There we go. So, what kind of setup am I looking at? Do I like the instrument? How am I rating the risk? Is there room to grow in the trade? And that became an issue last night when we were looking for a couple of trades in the afternoon, but we were right at key support and or resistance levels. Where's my backup? Where's my backup to the backup? Okay, this is the traditional model things I'm looking at. Am I willing to scale in? Where am I looking to scale in? If I'm not, then where's my hard stop? Okay. So yeah, every one of the students in the live trading room has access to this. You guys should all have access to. I mean, maybe you're Gary. I'm not sure. Maybe you're not. Maybe that's why you're asking. But if you are, you should have access to all these different things I'm showing here. And if I can't scale in the trade, I historically won't take the trade. There are times where I'll take the trade regardless. But I like to go ahead and look at a trade because for most people, it's really hard to be precise on your entries every single time. Now, a lot of people really like my entries, and in fact, John will talk about that too. He really loves my entries, and a lot of the students love my entries. But I usually like to look because after all the years, I still can't get every single entry timed to the tick every single time. Now, some of this is going to go ahead and change a little bit, admittedly, as of next week. There's going to be times where I'm going to, just pretend I'm a small lot trader, only trading with a handful of contracts, just so people can watch that. So a small lot trader can kind of see how I handle that. For years I would sit here in the room and say, look, if I were back, had to rebuild, from day one, and I used to think if I could give all my money to medical bills for my family or something and start all over, here's how I do it. Well, I'm going to kind of show a little bit of that next week, but I'm getting ahead of myself because that's some of the stuff changing. So if I'm not willing to add to a position, usually wouldn't take it. Is there room to make a profit? Never play with house money. Okay. Yeah, it is going to be great, Russell. Yeah. And like I said, it's about 29 different things we'll be going through. So pretty exciting. So here, never play with house money. That's important. That is so important. A lot of people go ahead and do that. A lot of students, even when they first joined the family, would say stuff like, "Oh man, great trades, Rob. Now we can, bet the farm on the next one, or now we're using the house money on the next one, or now we got money to burn on the next one." Okay, so basically, the going ahead and trying to understand that you earned that money. You earned that money on those trades earlier. And so going ahead and now that's money you earn. I mean, you pay live trading room fees, you pay data feeds, you pay, other educational services or informational service fees. You're taking time away from your family. There's lots of things that you're paying dues on. So when you earn that profit, it's not just house, money. Okay, so I won't harp on that today too much. I've also put little videos out on the next topic. The next one will become important. Avoid the Superman, Tasmanian Devil, or for the lady traders, of course, amongst us, Wonder Woman, Tasmanian Devil, and Little Piggy complex. So this one certainly was one of my key downfalls in my trade. And avoid placing blame on errors anywhere but myself. I have no one to blame. I made a series of mistakes. Bernanke was going ahead and speaking, but I'm the one who pulled the trigger. It's no one to blame. Everybody likes to blame everybody else for their losses, their mistakes. The kids came in, hit the keyboard. the phone rang, whatever the case may be. But we have to take self accountability, and then an absolute focus on slow, steady, and consistent profits. Those were what I did right that allowed me to have that run. Now, a couple of these things are where I made the mistake. Yeah, or like, John, exactly. During the Dallas Traders Expo, when I was in that trading competition, the person I was trading against had made a comment about their broker, during the presentation. So we just got to take accountability, for those, just like I am with my trading right here. Okay, so hopefully that's a good learning lesson right in itself. You own up to your own mistakes, you learn from them, and move on. My last trade back in January 2010, where I took the hit, was, and again, it was, I used the word hit, but relative to my biggest win, I had made a lot more than I'd lost on it, so I mean, it was a good year. But the point being that what I did was I basically chased into an entry. I had an idea. I knew what I was looking for. I went back and looked at another chart for a student, and then all of a sudden I flipped back to the other chart, and next thing you know, my chart had already started moving. I tried using limit orders to get into my position, which is something I typically do, unless we're in extremely fast market conditions. Try to use limit orders on the trade, and basically what ended up happening was I kept missing it by a tick. Okay, well, to make a long story short, so I finally got my fill, and then the market started going back up. Okay, and so I chased into that trade. I'd been hunting it, throughout the morning, and I just happened to go look at another chart for a student. Am I blaming the student? Of course not. And I take full responsibility that I chased in it. Well, guess what? For 17, you know what, Kawork? I don't even know. Haven't focused on that part for me. But what I do know is that what I told myself then, I spent a day or two afterwards doing kind of what we did here a week or so ago, going through things intensively, and then got right back on track. And here I was, even just 4 weeks ago, not chasing into a couple entries I had the opportunity to chase into. So I learned from that lesson, just like I'm going to learn from the things I'm reviewing from you here. That's what defines you over the course of the years. Do you learn from your mistakes? What is that old expression that a lot of people make? Insanity is the definition of doing the same thing over and over again, expecting different results, right? Anybody ever heard that? So that, that's, kind of what we're trying to avoid ourselves, and what I usually do a pretty good job of doing. So that's kind of where we're at. So what we're doing, let's just take a look. Okay, good. I still got a little bit of time. So what went wrong with my trade there? And hey, Dr. Phil, you know what? Those questions, let's go ahead and answer those as we get into the regular, because you, of course, have been with me for a long time, and I know you're going to continue to be with me. Those are just regular day-to-day questions that I can work with you on, or maybe when John and Hubert get on there. But I want to kind of get through this part, okay, bud? And if you don't mind there. So, but good morning, Dr. Phil. And so basically, kind of given the history here. Yeah, thanks. For those of you that don't know, the general synopsis is, well, you know what? I'll just go through this part, and then we'll kind of talk about the trade as a whole. Well, you know what? Hey, we'll do it this way. What the heck, right? So basically, what happened was with the Russell 2000. I went ahead and did something here that I typically don't go ahead and do. I took initial entries on an instrument where my key support levels were actually down much further down below, well over 100 ticks below. Okay, that is a big no-no. So I took a long side trade, and then what I did was, as I was going ahead, I was long. I immediately, shortly after I got into the trade, I immediately had a profit of about 4 ticks. Now, we'll talk more about what led up to that. But basically, what happened in a nutshell is yeah. Oh, Matt, you know what? It was right up. Let me help you there so you can kind of follow along. That's why I moved the charts back as well. The exact time I can't tell you, unfortunately, but it was right up here on this bar here, as I recall. Okay. Can you see my charts? Hey, good morning, Jack. Can you see the charts here? I'm on the charts right now, gang. Just make sure everybody can see them still. Okay, Jack, you may have to log out and log back in. Okay. Looks like everybody else is able to see them. Okay. So make a long story short, I took a very aggressive trade up here at I started out right about 835.80. Now, make a long story short there. So that's right about where it was, Matt. Okay. And but the key backup was back down here around 825. No, this is the Russell 2000, gang. This is, does everybody see that says TF? That's the Russell, not the Euro. Okay. But getting back to it here, so what happened was I went ahead and took a more aggressive trade, and we'll talk about why in a few minutes, but I just try to give you the synopsis. Took the more aggressive trade up here at 838, I'm sorry, 835.80. And then the market pushed down, right down into here, gave me an opportunity. When the market popped back up, gave me about 4 ticks. Well, to make a long story short, I haven't been going ahead. Yeah, this is the Euro over here, but this we're going back in history here and looking at this from a couple weeks ago, Jonathan. This is the Euro over here. That's completely independent. Here, let me just do that. Okay, so that people are focused on the right things. All right. So basically, the market then pushed down, popped back up, gave me a chance to make about 4 ticks. Okay, I added in a few contracts down as it popped down. I had a nice little feverish movement, gave me about 4 ticks. Now, the thing is, unfortunately, and I'll talk about the evolution why, I've been going for a lot more. For a lot longer here. In fact, like I said, the last free event we had, I mean, what, like 72 ticks in like 10 seconds on one of those trades, something along those lines, 72, 73 ticks, whatever it was, in a matter of a handful of seconds. So since the Japanese tsunami crisis, I've been widening my profit targets, going for bigger and bigger profit targets, looking for bigger gains. So here I had a profit on the board, and I chose not to take the profit. Video's great. Sound is suddenly so-so. Testing 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Video sound still good? Okay. All right. Looks like everybody else is still good. So let's go ahead and pick it back up here there. All right. And so bottom line is that what had happened was I was going for more and more profit targets over the last several months. And there's a reason why we'll get back to that. I'm just trying to give the overall synopsis. And then what happened was I didn't take my profit. The market went ahead and pushed down against me again. At that point, I then had an opportunity. I added into my position, and I had an opportunity as it popped back up to go ahead and take a smaller profit. Now it's even smaller than the first profit. Okay. Then it went ahead. I didn't take that profit. Kind of like, well, you know, it kind of gets to almost the I want to get paid for this trade types thing. Okay. It's like, well, could have had the 4, which is much less than I wanted in the first place. Now I'm getting less of an opportunity. I'm going to see if I can get a better bounce because my key resistance at that point then was about 10 ticks, 15 ticks above there. So I was still looking to get a little bit more profit. Well, what ended up happening then was at about $830.50. What I said to everybody, and here's how come some people end up making money there. Well, first of all, some people just made money because they got out earlier when it bounced, it thudded instead of sprung. But down when we got to 830.50, I'd commented, "Hey gang, this is actually where if I weren't already in a trade, I'd be looking to get into the trade." Everybody remember that? So we had a nice extension on the bar at that point. That was a nice 100 tick plus extension, and real nice there. And 800 plus, Jeffrey. And so the had this nice range extension. And so, like, hey, gang, if I wasn't in a trade, this is where I'd be looking at. That was at 830.50 when I mentioned that. And then, of course, it did have the nice pop up, right? And so that's where other people went ahead and said that they made money on that trade. Okay, gotcha, Michael. Michael says that's where he went in. Okay, Michael in there. So basically, so it popped up here. At that point, then, when it popped up, I had about $3,000, a little less than $3,000 profit showing on the board. Okay, because I added in because it's like, well, hey, that's where I'd be going ahead. And so here again, Bruce says, me too on the 6E. So basically, people went ahead and used that as an opportunity if they weren't in a trade, because the whole trade started out very aggressive, which meant a lot of traders didn't even trade because very aggressive. I usually call that a Rob Hoffman or Goldman Sachs trade. And so down here, then we've got the max range extension and the feverish price activity. People like that. Angela says that she did as well. And it was about roughly I think I had, I don't remember exactly how many I had there, to be quite honest. I believe it was I don't know, approximately 100 or so. It wasn't that much, comparatively speaking to some of my bigger trades. But and so it popped back up there, and it went ahead then had about a $2,900 profit approximately on the board there. And Angela says, I made some money on the euro there as well. So, hey, thanks, Walter. And I don't know that for a fact, so I'll just leave it then at approximately 100. Let's leave it at that, since I don't know. Sound like you know, but I don't know for sure. So yes, Kavork. And so basically, to make a long story short, it popped up, had a profit on the board. So I can see some people are taking copious notes. So make sure you get your facts straight, because, man, I've seen all sorts of craziness out there. I had people say that I lost money because I had my teeth pulled, and that's why I lost money on that trade. Newsflash, just for clarification, I went in and had 2 teeth pulled later in the day and had my bridge work done after the trade. Okay. So let's get the facts straight, kids. But anyways, we won't worry about that stuff. I definitely haven't wasted my time on that. Yeah, 2 teeth, and it was so. Here I was in this trade. I ultimately closed the trade out at about 11:30 Central Time. Meanwhile, at 1 o'clock in the afternoon, I had a scheduled dentist appointment to pull 2 teeth and put a bridge in from my childhood. There were 2 teeth that were sore. So, anyways, that was exciting. Yeah, that was fun. And hey, but I still got back to open up the live trading room that night, if you remember. So hey. So anyways, right here, I had another profit. I had roughly $2,900 on the board. Here again, I could have gone ahead and taken a profit. What did I do? Well, we already know, right? I didn't take the profit. So this right here, this point, first of all, even up above, this went ahead and above. Well, I think it's a good learning experience, actually. So I really want to share it. So so I had the profit opportunity up above twice that I could have taken it. What I was expecting to have happen in the market didn't. It's what I called it thudding. It thudded instead of boinged. So here I was looking for it to jump down, pop back up with a boing. Okay, it keeps erasing on that screen. Let me just pop it up here, because this is extremely important. It went ahead and came down and thudded, giving me small profit opportunities instead of going ahead and coming down and boinging. Okay, so that was normally, if I see something like that, what do? I immediately take whatever the market gives me. 4 ticks, 5 ticks, 6 ticks, whatever it is. But I went ahead and decided to be a little piggy that day and go for the bigger win. So that right there, just so you know, is the key thing. I had 3 different opportunities to go ahead and exit that trade with a profit. Okay, not a clean profit, not the kind of profit I like to make. Not a, it was a very aggressive trade, which we'll talk about in a few minutes. But I went ahead and had the opportunity for profits, and I screwed up big time. After all these months, what is it, 17 and a half months, whatever it was, since January of last year in the live trading room, if I had a situation where a small profit went ahead and by having instead of taking the small profit, went for a bigger one, that went in and cost me. Big mistake. Okay, so that's why I want people to learn from, because what I find, well, Edison, like I said, Edison, so it says, why didn't you take the profit? Well, we're going to talk about that in for a moment. What happened was, well, I'll show you in just a few minutes. So give me a few minutes there. And so really, what we had there, and I just focusing on that for a moment, multiple opportunities to get out small profit. Usually I do. But there's some things that led up to me going ahead, yep, that's right. You've heard me say it many times: bears make money, bulls make money, pigs get slaughtered. Now, I didn't get slaughtered, but I lost, plenty of money. Okay, and it stinks, and so I want people to learn from it. Okay, and so so it's a real opportunity, because here's what happens. Many of you have probably found yourself in this situation. You go ahead and you're great at hindsight trading. Oh man, I should have stayed in that trade for X number of dollars. Hey, that person should have stayed in there for this much money, right? You get yourself in that position where you find yourself saying, woulda, coulda, shoulda. Everybody's great as armchair quarterbacks. It's amazing how many people have armchair quarterbacked my trade. Everybody in the world is suddenly the world's greatest trader. In hindsight, and so that's the world we live in, right? We all see it, chat boards and everything else. So, but the thing is that what I normally do, and take the small profit if it's not going my way, I did not do. And you like that? Well, it's true, isn't it? Armchair quarterback is kind of sitting back there after the fact saying, oh, you could have, should have done it, that way, and so on and so forth. But of course, I keep it real and on the right edge of the chart. And actually, the whole reason we're having this conversation is, for those of you that don't know, that day, it was past the time the room was supposed to close. But I told everybody, I'm staying with the public on this trade, even though I was in a loss. I said, I'm seeing this through. Okay. Many of you have been exposed to situations where people walk off the screen if they're in the middle of a loss. They shut down the rooms, they hide their charts, whatever. I did it right there in front of people, win, lose, or draw, just as I do every day, win, lose, or draw. So just to go ahead and make sure we're talking about that. There was more warning signs as we're getting down to that area. After this drop here, just picking it back up, because I know John's supposed to join in about 13 minutes. Picking it back up here for a moment. So when we got to this area here, we had higher volume volatility, okay? And I went ahead and I told that is why we really, really like you. You're transparent and will teach us reality. Yep. That is definitely my commitment. So that's why I told you guys. And in fact, I was planning on Sarah calling the dentist and telling her I was going to be there late. I had a 3-hour appointment, and I was prepared to stay here till the darn thing was done, because that's how you got to do it. Okay. And oh yeah, no, yeah, absolutely. It's about 307 actually, Eric. They're plus like commissions or so. So no, that's absolutely. I have no problem with that. And so the bottom line here then is, this went ahead and had a push down here. It's hit into what I call max range extension territory, which we don't have time to discuss today. I'll be happy to discuss it tomorrow. And that's why I said, look, gang, if I weren't in a trade, this is where I'd be looking to enter the trade. Okay. hit 830 round number support area, had a max range extension, and I know some people jumped on that and made some money there. And that bounce is what gave me the bounce to actually have that profit on the board that I could have taken. Now, so anyways, Mr. Piggy, Little Piggy, went ahead and wanted the bigger win, didn't go ahead and take it. So to make a long story short then, so I can get back to these key concepts to learn from, what it did was then it rolled back over. And at that point, it's like, oof, that's not good. And so what I basically did was I told people that at 825.50, because 825.50, we'll talk about this in a minute, but 825 was like the last bastion of support for this. That was the area, and that's well beyond the normal area of distance that I'll enter a trade. The best I can recall, the biggest gap in support between an entry and my conservative levels that I've entered was like back last December in a trade in crude oil, I believe it was. Crude oil or gold. I'm sorry, I don't remember which. Maybe one of you does. It's been with me for a while. And I entered the trade about 60 ticks above the key support. And so this case, this was a case where I went ahead and actually had well over 100 ticks from support. But what I was finding myself doing was getting more and more and more aggressive with my entries, and I'll show you why in a few minutes. Well, to make a long story short, we got within a few ticks then of that 825 level. What I told the group, if you recall, at about 825.50, I said, look, I'm done. Everybody has a stop loss limit that you can set for yourself or that you have automatically. Well, at least my broker does. How many of you have brokerage firms where you can set your stop loss or that you have like a stop out or an auto stop out that you either set for yourself? How many of you have that? Okay, yeah, great. So same with me. So you can call your broker, say, I want to go ahead and I want to set my stop loss at a percent or a dollar limit. Okay, and unfortunately, mine was set to percent, and so I misjudged my percent by a few percent because, of course, my account has been growing and growing and growing, and I should have just done a flat dollar amount. So just note to self, consider whether if your account grows regularly or fluctuates, you may want to go ahead. Yeah, I haven't. That's who I have, and I can do that. So what you can do is you can call your broker and sit there and say, look, I want to limit my loss to 1%, 2%, 5%, whatever. And so you can go ahead and set your loss. All right. Well, so anyways, my loss was hit. And so I went ahead and because I misjudged this by a few ticks, I said at 825.50, I said, gang, I'm done. And Andy says he put a sticky note on his monitor to remind him of the dollar amount. Well, like I said, you could just put a dollar amount out there instead of doing percent. I always thought having a percent was, easy enough. But, when you're in the middle of the trade there, it doesn't go ahead and that doesn't necessarily happen. So anyways, basically, what you do is you can set your percent, and I would encourage everybody to think about setting their percent that's right for them, that they, based on the money they can afford to lose on any given trade, okay, and be comfortable with that. Does that make sense? If your broker allows you to go ahead and do that, have your percent set to whatever you're comfortable losing on any given trade. Everybody with me on that? Okay, my group behind me is. How about you guys? So, all right. So just if you haven't thought about that, consider it. Now, the one caveat to that is, like one of my successful students, Lance, for all those of you that haven't seen my new and small lot trader video, one thing to go ahead and keep in mind, though, he was growing and growing and growing his account. He started out with a really small account when he started with me. He kept growing the account, but he forgot he had set a really small dollar amount back in the day. I don't really want to speak for exactly what the dollar amount, but I believe it was like low 4 digits. And so what ended up happening was he then one day had like a 30 contract trade on or something like that. This was like back in 2010, and he went ahead and he got blown out of the trade by his broker because he had set that smaller dollar amount and never raised that to account for the bigger contract size that he had been able to achieve. Does that make sense? That's one caveat you got to think about when you're doing that. If you're going to trade the different sizes, you need to go ahead and so anyways, yeah, absolutely. Well, I think it's a great, yeah, you're very welcome, Eric. I think it's a great opportunity to learn from these different discussions. So just that's something to remember. It's a great opportunity. Call your broker. You can set something, but make sure you remember exactly where it's at. Well, needless to say, at 825.50, I went ahead and said, look, I'm done, gang. That's it. I was actually looking to go ahead because it was right there at that 825 level. I was looking at going ahead and just taking myself out. I had to admit I was wrong. I didn't take the 3 opportunities for profit. Well, my daily limit ended up going ahead then getting hit. And so I didn't get the luxury of taking myself out. The broker ended up taking me out on that trade based on the percent that was set forth. And so that's a learning lesson, because the bigger the dollars that you're playing with, like me, having a big account as a big institutional size trader, hey, those fluctuations, when you start talking hundreds of thousands of dollars, you start losing track. If you're basing your account on a percent, you start losing 10,000, 20,000, 50,000 here, 50,000 there. For instance, for those of you that don't remember, that Monday, John was trading for me. He went ahead and had a $50,000 trade on. It dropped down to negative 12,000 and went back up to plus 47,000. So you see the big swings in there. So that's something to go ahead and think about there. And so anyways, so that's what happened then. I didn't get to take myself out. When I was going to, in fact, I literally said, here's what I said: I'm done, gang. That's what I said. It's 825.50. I said, that's it. I'm done. And so my next step was then I was going to start working my way out of the trade, taking size off the table. And unfortunately, I went ahead and didn't get that luxury because I misjudged my percent in the middle of my trade. So that's the long and the short of that particular trade. And so getting back to the learning opportunities for it then. Okay, what do I got here? Well, a few minutes. Hopefully, John will indulge me here. Actually, I'll have to put on a headset in a few minutes so I can even hear if John is here. So let me just kind of get through this. And John, if you're there, just give me a few moments to kind of get through that trade. So here's kind of the evolution of what went wrong with that trade. Okay, and so here's the learning lesson. Let me try to get a headset on while we're talking about this. Is basically physical stops removed since the flash crash. For those of you that don't know, I had physical stops in. Does everybody know that, or do you understand that now? I used to use physical stops where they were pre-positioned up until the flash crash of last year. And so that's one thing. So physical stops removed. Why was that? Because like I said, I was doing a bunch of trades where, in fact, I was down in Florida at the time. I had a group with me, just kind of like I have a group behind me right now. I had a group with me, and I was getting entries, and the market was moving up so fast, it was hitting my stops, my profit target stops, before I could even go ahead and move them a little bit. Because if you recall, the first couple of days after the flash crash, the market went ahead and had really wide swings. Everybody remember that? How the currencies and that were really wide swings. Okay, so basically that's the first thing that led to a couple weeks ago, is because I removed the physical stops, just got used to that. Yes, what we're talking about is the flash crash from last year is when I'd gone and removed the stops. Okay. And yeah, Ed says, yeah, the next day we had a limit up on the S&P. Basically, it was very volatile the next few days. Well, so what I was doing is I was finding myself getting into entries, and I mean, good news, bad news. They were working so fast that my profit targets of like 20 ticks or more were just getting nailed really fast. Before I could even move them out of the way, they were getting nailed. Well, so that happened a couple of different times right in front of my live audience down at a condo in Florida, and where I was there. That I went ahead and I just took those off for a few days. Well, what I found was this ended up being much nicer going ahead and leaving them off and just having the mental stops at the conservative levels. So I got kind of accustomed to that because it made my life easier. Then another thing that led up to it was that earlier this year we had a slower start to the year, and the mental stops were always at those conservative levels, SK. And so, which we'll hopefully talk about a lot more as we go into tomorrow. We'll go, or possibly after John gets done speaking here in a little bit. So basically, we had if you have like the initial level, and let's say this was more aggressive, and here's the conservative, just the stop is below there. Okay. And so basically, then we had a slower start to the year here. That was the merger between myself, John, and Hubert. And we had a whole bunch of new people, so I really kind of dummied it down, started getting a lot more conservative, again, because I had an influx of all the new student family members that need to learn things from start. Also, we went ahead and at that particular time, I was doing a lot of crude oil and gold trading, for those of you that recall, in January and February and such. Oh yeah, definitely complacency is absolutely, in fact, like I said, part of that process here, Steve. No doubt about that. That's what I'm just kind of reviewing the different things here that I think were my failures, my undoing. Okay, with that particular trade. So it's so funny because everybody's like, oh my gosh, it's the end of the world for Rob and so on and so forth. It's like people don't even understand, my account size, my trading. I'm an institutional size trader, and everybody's so worried. But I'm doing just fine. It stinks. Losses stink. They stink. No matter what you do, how you do it. Exactly. For any of you, exactly. I just said not only for a long time. We'll recover and move on. My losses have always been my shiny moments. This one I expect to be no different. So Japanese yen crisis, that came out with good part. So first of all, removing the physical stops there. Okay, going ahead and having a slow start to the year, not just because of the new student family, but because of also I was doing a lot more gold and crude oil trading at the beginning of the year. If you remember what I said earlier, the FOMC meetings, for instance, nothing was happening with those, and so basically. Hey Steve, maybe we'll have a chance to talk about that. If not today, let's do that tomorrow. Okay. Yeah, I'm showing my screen, gang. Can anybody see my screen? I'm marking it up right here. If nothing else, Matt, just listen to what I'm saying. Okay, great. People are saying it. Thank you. So then the next thing is, so we had a slow start to the year, doing mostly gold and crude oil up until the end of February. And then until the tsunami crisis, things were kind of slow, doing a lot more of the conservative style trades. Well, then the Japanese yen crisis went ahead and hit. Okay. And what basically happened with the Japanese yen crisis was I was doing a lot of small contract trades. I made, approximately, $21,000 that week alone, let alone all my other stuff that I was doing. But just on the Japanese yen there, it was approximately $21,000 there. Okay, and so what we're doing is going ahead and by the way, don't forget, gang, if I'm missing any of your questions, great. John, I'll be ready in just a minute. There, are you already opt? Um, but I just want to kind of cap these things. Here's the good news: if I'm missing anybody's questions and stuff, we can go ahead and also carry on with this tomorrow morning as well. But John, I just opt you there, so you'll be ready in a few minutes here. So the Japanese yen crisis, that's when volatility started picking up. Does everybody remember my YouTube videos and my videos on the Trade the Markets website, stuff like that, where I mentioned to people, hey gang, the summer I think is going to go ahead and be a really good summer. It's going to be very volatile, lots of action. Okay, everybody's saying they remember that. Okay, so basically what happened then was the Japanese yen, even on like a lot of those were like 1 to 4 contract trades. I was going ahead and basically picking up from there and just kind of carrying that torch forward, looking to accelerate the year because it was a slow start to the year. Then I did my mid-year review on my goals, and even though I was, having a great year, all things being equal, especially with the slow start, I was having a really nice year. I was trying to accelerate that because my goals for the year, I wanted to be way up here. I was here. So I wanted to take some more aggressive trades. I announced to the room that I was going to be taking more aggressive trades. So I didn't just take conservative trades or conservative aggressive trades. I was also taking aggressive trades. So I widened the distance on my aggressive entry levels to the conservative stops. As I previously mentioned, and did that by over double effectively. Typically, I look for my backups to be much tighter, much closer in proximity. In this case, it was actually technically well beyond double by my traditional standards, but even by my more recent standards, this particular trade was over double my normal maximum. Did everybody catch that? It was over double my normal maximum. Backup plan for my conservative levels. So I stretched the envelope too far. Okay. All right. So that's another mistake that I made. Okay. And then I failed to respect my indicators because before the trade, basically on the daily chart, we were kind of in a what I call a choppy kill zone or piranha. The market as a whole on the days trading back and forth like this, I draw the little circle in there so you can see the ugly piranha, or northern pike in this case, I guess is what that'd be. But the bottom line is the daily chart was chopping back and forth, but my indicators on the intraday basis started to roll down on top of me. So instead of taking my small profits that were afforded to me 3 different times, I went ahead and stayed with this trade, which was quite a mistake. Then, I basically repeatedly failed to exit with the small profit where we got the thud. We talked about that. And then finally, a lot of this had to do with the fact that I just been focusing on too much of trying to make money trading more than, earning money off the room itself. The thing is, and what people often forget is a lot of educators make a lot more money educating than they do trading. I try to go ahead and make a lot of money trading. And for those of you that have been with me, you've watched big 6-digit profits. I like to go ahead and try to make my real money trading, not just off of the trading room. Hey, it's a business. John and Hubert will tell you that. Education is a business too. I'm not here per se for charity, but I am here. I try to really help people and have them watch me learn, or trade, or watch me trade and learn from me and try to teach them each and every day. So I focused a little bit too much when I had my goals, even though I had such, a great year already, especially with the slow start to the year. Nonetheless, I ratcheted up my aggressive level, my aggressiveness, to go ahead and try to get me to that even higher level that I wanted to be for my yearly goal. So I pushed too hard for the yearly goal, which effectively put me in the trap of what I tell people here. People set daily goals for themselves, and the problem with that is, it's great, but what happens if you've only made $250 on the day, and your goal is $500 a day? What do? Do you go all in, double up, triple up, something like that? Um, on a trade. Now, and like I said, tomorrow I'll try to carry this on, may possibly with John after John gets done speaking here. I want to talk about the whole concept of averaging in, averaging down, averaging to a winner. There's a whole bunch of things I still want to continue. You know what, Steve? It's actually I set myself more of a monetary goal. It wasn't a percent goal. I set myself more of a monetary goal, and I was shy of that because of the slow start to the year. But the bottom line is, unlike a lot of traders, that are that do this, that are trading on simulators or $5,000, $10,000 accounts just so that they can say they trade live. Anybody who knows Rob Hoffman knows that's not true. I have a very real, and substantial account that I go ahead and use to trade my real money with, just as John does, as well, and Hubert. So, keeping it very real. And John had that $50,000 trade back and forth on, a week and a half ago or 2 weeks ago, whatever it was now. So, on one hand, one of the improvements is we're going to be showing a lot of smaller lot trading, smaller profit or smaller lot trading, showing 1 and 2 lot trades as well. We're going to pick times and days and that we're just going to do hey, look, I've only got 5 contracts in my name. Here's how I'm going to trade. Or I've got 2 contracts in my name. Here's how I'm going to trade. So I'm going to be teaching people those things. But at the same time, the thing is we're very real traders, and so I think a lot of people, and that's why I have so many institutional level customers here, because of the fact that I do it very real, and which is a double-edged sword, right? Because there's a lot more size. We've got people trading very big size in the room, so that's a double-edged sword. And I know some of the traders aren't happy with so many institutionals being here, but they're here because I have something to teach them. So these are the mistakes that I went ahead and made in particular. We could talk more about that. I need to let John get on here. I'm unfortunately over his time. I apologize, but we can just let him carry on a little bit longer. But I want to kind of share with you guys some of the things that led up to this, and some of the mistakes that I made and how I went about making those. And so one other thing I just wanted to point out, a couple of things. My backup and my backup to the backup were violated. My backup was way too far away, something I don't normally do. I had the little piggy complex because 3 times I had a profit on the board, and 3 times I elected to go ahead and stay with that, trying to make a bigger profit. Big mistake. No, Max, no. And actually, you know what, Max, I've been repeatedly telling people about, about the winning streak. The winning streak kind of really was getting to the point where it bugged me, because it was almost an expectation. It was almost like an expectation. It's like I spent the irony is, Max, I spent the last 4 weeks before the loss telling people, look, gang, you guys are more concerned about my streak than I am. Okay. So basically, that was kind of a, what do you call it, albatross? You know what I'm saying? There you go, a sort of Damocles. So the bottom line is that the good news is I have some ways to prevent that now going forward, which I'm going to actually share tomorrow. And so basically, then to sum up here too, the last thing is I used to have a very absolute focus on slow, steady, consistent growth. Yeah, some weeks, or in some trades, $30,000, $20,000, $18,000, $15,000, et cetera. That's all well and good. Nice slow. It's amazing how those $1,000 days, $5,000 days, $10,000 days all add up. That's all well and good. But you know what? There were days where I didn't take a trade at all. I focused on slow, steady, consistent growth until this confluence of circumstances back here hit. And then I went ahead, like I said, did this mid-review and announced I was going to ratchet up the aggressiveness. Okay. So basically, Randy, you know what? We'll talk about that. That's what I was saying. I'd like to talk about the concept of averaging into winners, averaging into losers. I want to talk about that more. But right now I'm like way over the time, and John was supposed to start speaking, so we're going to continue that on. The good news is, Randy, you're already in here and part of the room. Even if for some unknown reason we didn't get to it tomorrow, Not no no, I definitely was not wiped out. I am definitely still very much trading. And that's the thing is everybody's like, you got wiped out. Nobody even knows the size of my account. That's the irony. People all have their speculations, but that's okay. Obviously, I'm still very much trading. So the bottom line is that what I want to do is go ahead and that's right. So there you go, Steve. So the most patient trader you've ever seen lost his patience as I tried to go ahead and have the mid-year, as I had the mid-year review, and I wasn't happy with being here when I wanted to be here, and so I ratcheted up the aggressiveness, which in itself was not a big deal. But then I needed to go ahead and recognize the warning signs when I had my profit on the table and it was thudding instead of boinging. I needed to go ahead and take my profits. Basically, a very aggressive trade that I didn't use very conservative, stop management and money management on. So that was a double negative. Um, yes, it was David. So David S. So basically, I wanted to go ahead. You are a phenomenal trader to watch, Rob. Well, thank you, Scott. So basically, and what it boils down to there is, it's a loss. It stinks. It was, certainly a loss that I'm not accustomed to taking. In fact, like I said, my last loss back in January of 2010 was fractional. And fractional, my biggest single win of the day. You know what win of the day, the single win of the year. So that was kept in proportion. This one, I made mistakes. Tried to review some of his mistakes. We can even potentially talk about it a little bit more tomorrow. But I want to also talk about the 29 improvements that are kind of coming out of this, because, like I said, the last mistake I made was chasing, and 17 months later, I'm still not chasing instruments. Here we are, 17 months later, still doing that. So I learned from my mistakes, and it's funny, a lot of people make these mistakes every day, and I'm human. Fortunately, I try not to make them very often, but I'm human and I made mistakes. And that's why I wanted to share this with everybody to make sure it's a learning opportunity for them. Hopefully, in some small way, I'm helping people out there in seeing what I've done wrong, so that people can learn from it. And I'll continue to try to help you as we go forward with this as well. Both today, tomorrow, and of course all of you that are part of the live trading room. Um, you know, same, so forth. But I'm still going to go ahead and be trying to make money trading, obviously. But I'm going to do some things to additionally help, like the smaller lot traders net, which I think are going to be really neat. Some of the ideas I already share with you, but I got about 29 things to go through with you tomorrow. So, with that being said, I do appreciate you guys going ahead and listening, and I tried to answer a bunch of questions. And we'll have more time together as well, and we're going to go ahead and keep on that path. And I'm going to go ahead and I'm looking forward to just like in January 2010, that was a huge launching point of future success. And now with what I'm going to be doing to help the small lot traders as we go into discussing those things tomorrow. So stay tuned for that. I think it's going to be a really exciting time, to be learning and growing with us. So, with that said, I'm going to turn it over to John, and then I will be back with you, and then we'll go ahead and pick it up again tomorrow morning again, and then I'll have Hubert with me as well. So, John, I apologize about running over, but as you know, I could talk about this all day long because there's so many things I want to share. But I'm going to turn it over to you at this point, and thanks, Gage. So we'll talk a lot more about this as we, kind of go forward there today and tomorrow. Okay, thanks, everybody.